portfolio concepts will follow the sequence in the curriculum. On this reading, though, there is some good news and bad news. The bad news is that this is about 100 pages in the curriculum. The good news is that about 80% of this material you have seen before, either at level 1 or in the equity segment of level 2. So the key, in my opinion, would be to listen to the lecture carefully, read the summary or quickly go through Schweser if that's what you like to do, and then practice the questions. So don't spend too much time reading the curriculum, because most of this stuff is material that you ideally should know. Okay, so the sorts of questions that are addressed in this reading are questions that should look familiar. What are the characteristics, what characteristics of a portfolio are important? How may we quantify them? So what's important about a portfolio? Ideally, you want high return at a low risk. Speaking of risk, what is risk and how do we model risk? If we could know the distribution of asset returns, how would we select an optimal portfolio? Do you remember the optimal portfolio from level 1? We are going to again talk about that same concept. What is the optimal way to combine risky and risk-free assets in a portfolio? What line did we create? This was the CAL and the CML. What are the limitations of using historical data to predict portfolios' future characteristics? This is new, but it's straightforward. What risk factors should we consider in addition to market risk? This we have seen in multi-factor models in equity. So not a lot of new stuff. Section 2 in the curriculum is mean variance analysis, and you keep seeing this term over and over. So what I am sharing with you here is an excerpt from the curriculum that is perhaps the best definition of mean variance analysis. Mean variance portfolio theory is based on the idea that the value of investment opportunities can be meaningfully measured in terms of mean return and variance of return. Markowitz called this approach to portfolio formation mean variance analysis, and mean variance analysis is based on the following assumptions. So before I read these assumptions, and these are assumptions that you need to also read a couple of times and memorize, and this should not be new. Again, you've seen this before. So most of our basic finance theory that we study at level 1, level 2, portfolio theory in particular, is based on mean variance. So we look at expected return, or we want ideally stocks that give us a high return. And how do we come up with a high? What do we mean by expected return? It's essentially the mean return that we are expecting. And how do we measure risk? Using variance or standard deviation. So that whole approach, which we inherently have been following, is called mean variance analysis. Now I'll just read this for you to help you remember this. All investors are risk averse. They prefer less risk to more risk for the same level of expected return. Expected returns for all assets are known. The variances and covariances of all asset returns are known. Investors need only know the expected returns, variances and covariances of returns to determine optimal portfolios. So essentially we are keeping things simple, and we ignore skewness, kurtosis and other attributes of distribution. We ignore transaction costs and taxes. So these are the assumptions behind mean variance analysis, and you need to know this. Okay. So section 2.2 talks about the concept of the minimum variance frontier and related concepts. So again, this is a quick refresher from left. So what is the minimum variance frontier? When you think of a portfolio or different possible portfolios, if you plot out risk of a portfolio measured in terms of, say, the standard deviation of the portfolio, so a combination of stocks or other assets, so the risk on the x-axis and expected return on the y-axis, at every level of expected return, there will be some portfolio that has the minimum possible risk. So if you take an expected return of say 10%, let's say that these are the different possible portfolios that you can create. And just to throw out a number for risk, let's say that this is standard deviation of 12%, this is 14, 16, 18. So is it conceivable that at 10% return, expected return, you can create multiple portfolios with different levels of risk? It is. Is it conceivable that after a certain level you cannot reduce risk any further? That's also conceivable. So there has to be some portfolio such that that offers you the minimum variance or minimum standard deviation for that level of return. So if you essentially, then you can essentially create something like this. So you can have you can keep going. So at different levels of return, you can identify different portfolios with different levels of risk. What does each dot here represent? A different portfolio with different combinations of assets. Two portfolios with the same assets in different weights. Are they separate portfolios? Yeah. So if the weights are different, even though the assets are the same, that's considered a separate portfolio. So when you join these, what's special about these portfolios that I'm connecting? They are saying for a given level of risk, they are giving me the minimum variance. Is it possible that at a return of say 9%, I have a portfolio that gives me this level of risk? It is. So effectively I've taken every return that I can get and I am looking at a combination of risky assets that give me the lowest possible risk. Okay, so a key point when we do this analysis is that we are only looking at combinations of risky assets. We haven't put in the risk-free asset. So this curve is called the minimum variance frontier. All right, notice just from an academic standpoint, this minimum variance frontier is the whole curve, including this part below that line that I have drawn. An efficient portfolio offers the highest expected return for a given level of risk. So in blue, I am just going to put on this the efficient frontier. So this part is the efficient frontier. So what's the difference between the efficient frontier and the minimum variance frontier? Efficient frontier actually says at a given level of risk, I want a portfolio, say at a risk of 13%, I can get two possible returns. Either I can get 15% or I can get say 9.5%. Which portfolio is better? Obviously this one. So do you notice that the efficient portfolio is simply a subset of the minimum variance frontier? Why people worry about this part at the bottom, I don't know, but finance theory likes to identify minimum variance or minimum variance portfolios, which are all these, and then the efficient is only the blue part, which is the maximum return for a given level of risk. Okay, now again continuing with our level 1 refresher, and all this is not optional, unlike derivatives where level 1 stuff was optional and not part of your questions. This is very much part of your exam, so make sure you nail it because it's easy. So if you create a portfolio with two assets, one asset is your large cap stocks. So think of this purely as maybe a share in the S&P 500, and the other is government bonds. You are given the expected return of both assets, given the variance, given the standard deviation and the correlation. How can you come up with the expected return of your portfolio? Do you remember this? So if I tell you that you put 0.5 of A and 0.5 of B, I don't think I need to make you calculate the expected return. If you can't do that, then we have larger issues. All right, so I'm sure you can do that very easily. Okay, does this look familiar? What is the variance of the portfolio? And this is a formula you learnt at level 1, you need it at level 2, and you need it at level 3. So this should be on your primary major formula sheet, or ideally it should be totally memorized. So do you remember this formula? Again, I am assuming you can easily do this. It's just plug and play. We are given the weightages here. We are given the variances. We are given, what's this guy? This is the correlation between A and B. Is that given? That's also given. And these are the standard deviations, which would simply be the square root of these numbers. Again, conveniently, we have numbers with nice square roots. So you can solve for this. I'm not going to make you do it. If you are unsure, then just pause the video and practice this over here. Okay. Now, if you paused and resumed, these are the sorts of answers that you should have gotten. So what this is saying is that actually, if I were creating this, I would have put the weightages on the left. What does this first row represent? If you put 0 weightage in large cap stocks and the entire, let's say you are putting in 100 million, you put all 100 million in government bonds, then your variance is 100. Where did this 100 come from? Where did this 100 come from? This is the variance of, the 100 is the variance of the government bond. So all we are saying is, look at the 510%. So if all your portfolio is in government bonds, then this is the government bond portfolio with this variance, this standard deviation, which is a square root of 100, and expected return is 5%. Where did this come from? This is the expected return on the government bonds. So and so on. What are we doing here? We are putting 0.1 in large cap stocks, 90% or 0.9 in government bonds, and so on. So what are we changing as we move down? We are simply changing the W1 and W2, and at different weightages, what are we coming up with? The expected return keeps increasing. And what about the variance of the portfolio? That initially goes down and then it starts going up. Okay, so this again should look familiar. What are you looking at here? You have the variance on the x-axis. What do you have on the right? The expected return on the y-axis, variance on the x-axis. Is this the efficient frontier or the minimum variance frontier? This is minimum variance. Above this point is the efficient frontier. What does this point represent? This is the point where you have 100% government bonds and 0% what? So these percentages represent what? This is the percentage of stocks in your portfolio. So weightage of stocks is 0%, so that means 100% is bonds, and your variance is 100 and expected return is 5, and so on. So what is changing as you move along this curve? So what is changing? The weightage is changing. So as you are moving up, what weightage is increasing and what is decreasing? Yeah, the government bond is decreasing and the stock is increasing. So at this limit, what do we have? 100% stock. So our variance is what we saw for stocks, and the expected return is what we saw for stocks. Since most people have studied the stuff from Schweser at level 1, do you remember the examples from Schweser? There was Sparklin and Caffeine Plus, right? And that was the exact same thing. Now that you are more sophisticated, you are talking in terms of government bonds and holding a chunk of maybe the S&P 500. But the concept is 100% the same. Okay. This again should look very familiar from level 1. Just stare at this for a minute and then I'll ask you what you are staring at. This is straight out of level 1. Basit? Saad? Or let me just not even call your name, you know who's next. Okay, so key point, and this is like staring at you, straight out of the screen. Okay, so what did we just see? With a correlation of 0.5, we just saw this picture. Okay, so we saw this picture. What do you see on the x-axis? Standard deviation. So on the previous picture we said variance, now we say standard deviation. Is that a huge change or it's effectively the same thing? It's effectively the same thing. We've just taken, rather than taking the 100 over here, we now have 10. So here we are now just taking standard deviation. The y-axis is the expected return. Is this the same y-axis as the previous slide? Okay. So what about this particular curve? Is this the same as what we saw on the last slide? So this is the same curve. This says that if the correlation is 0.5 between asset 1 and asset 2. What was asset 1 in our example? Government bonds. And what was asset 2? This was stock. So what is changing as we move along this? The weightage is changing. Is the correlation changing? No, the correlation for this curve is 0.5. Okay. Now let's now, instead of saying that the correlation is 0.5, let's create a red line that says, that assumes that the correlation is 0. Is it possible that there is a correlation of 0 between two assets in your portfolio? It's possible. In fact, the correlation between government bonds and stocks might be less than 0.5. Okay, let's just, for the sake of this discussion, say that the correlation is 0 between two assets. So then you have this red dotted line. What is constant along the red dotted line? The correlation. What is changing? Again, the weightage. So all this is showing is that if the correlation is lower than 0.5, so here the correlation is 0, are you getting more diversification benefit? You are, because you can, while you are at the same range of returns from somewhere from 5% to about 15%, but because the correlation between the two assets is lower, you can lower the risk. So at this portfolio, you have a return of about 8% at a risk of 8%. What's a measure of risk in this discussion? With standard deviation, because we are doing mean variance analysis. So in mean variance analysis, the risk is defined as the variance, which effectively is the same as the standard deviation. So now what does this line represent, these two straight lines? This is saying that if we can actually find two assets that are perfectly negatively correlated, then we can actually create a portfolio which has zero risk. Now, if you are smart enough, I've seen questions on this in level 3. Level 2 I've not seen, as in you might be asked to do this, but it's lower probability. Do you think you can use the formulas you've seen earlier to figure out what are the weightages at which you can get a certain return with zero risk? So you actually can. So you can use the formulas earlier, and assuming that the correlation is perfectly, so they are perfectly negatively correlated, i.e. correlation -1, you can actually find this portfolio. It will be asset A, asset B, and what will you be finding? The weight of 1 and the weight of 2. So does this make sense to everyone now? Okay. Now that you have learnt a 2 asset case, can we easily extend it to 3 assets? We can. How do you come up with the expected return? So you have 3 assets. Let's say you have US bonds. So you have US bonds. You have, let's say, US large cap stocks. And then your third asset class is US, let's say, small cap. Okay. So these are your 3 asset classes, what's the expected return of the portfolio? Simply given by this. Is this hard to do? Does the expected return depend on the correlation between the three different asset classes? It does not. Does it depend on the variances or the risk? It does not. It purely depends on the weightage and the expected return. But the risk of the portfolio is more complicated. Now, when you only had two assets in a portfolio, let's say asset 1 and asset 2, how many correlations did you need to worry about? There is one correlation between two assets, right? So now that you have three assets, how many correlations do you need to worry about? You need to worry about 3, okay? And in level 1 and later you will see the formula for figuring out how many pairwise correlations you need to worry about. So is this obvious that with 3 assets you have 2 pairwise correlations? Is the correlation between 1 and 2 the same as the correlation between 2 and 1?
Yes.
Yeah, it's the same thing. So there are only 3 pairwise correlations. Now the way you remember this formula, and it's fairly straightforward, I doubt that you will be given this on the exam, but there is a learning objective that explicitly says that you need to know this. So that's why it's here. And I think it's not that hard. Is this obvious that your first 3 terms are simply the weightage squared times the 3 variances? Clearly the risk depends on the weightage of each asset and the variance of each asset. And then what's happening after that? The way I suggest you remember this is take each of the pairwise correlations, and then if you have correlation between 1 and 2, then always you have 2 W1, W2, and then the 2 standard deviations. Okay, is this easy? How will you remember that you are not supposed to take a squared of sigma 1 and sigma 2? The way you think about this is that since it's a squared term, the units need to be, when you multiply 2 standard deviations, you will get a squared. So make sure you just remember that. There are only 2 standard deviations in each term. Okay, so this should be easy to remember. And then not something you need to remember, but what if you extend to beyond 3 assets? Okay, the curriculum doesn't say that you need to know this, the learning objectives don't say you need to know this, but the text does give you a formula, and I can't imagine how you will be asked to use this on the exam. Even this is a stretch. Okay, now here is something new. Okay, so everything else was there in your brain somewhere, or should have been in your brain somewhere. This is the first new thing that we will talk about. Okay, so diversification and portfolio size. Very briefly, I'll just refresh your memory with something that hopefully you do recall. Do you remember this picture where we have number of stocks on the x-axis and risk on the y-axis, and as we increase the number of stocks, the risk would come down, right? So why does it come down? Because of diversification benefit. Now we are going to quantify that. So if you create a portfolio with n stocks, and in your portfolio you create an equal weight of each stock, and then let's say that you have 10 stocks, so n is equal to 10. What you then figure out is the average variance. So for each one of those 10 stocks, figure out the variance and then find the average. How will we write that? We will write that as the average variance. And then you figure out the average covariance. So you will have a bunch of pairwise covariances. You find out all the covariances and then find the average covariance between all the sets of 2 stocks and depict that as covariance with this bar for the average. Then this is the formula you need to memorize. Put this on your secondary formula sheet. So you need to know this, but you can survive without recalling it. So what is this saying? This is saying that the variance of the portfolio is 1 over n, times the average variance plus n minus 1 over n into the average covariance. Now the formula that you actually definitely need to know is this one. So if we make a simplifying assumption, so we continue with the assumption that we have equal weight. If we say that roughly speaking all the stocks have the same variance, okay, they don't exactly, but let's say in a given market the variance is roughly the same. So if you make this assumption and you also make a simplifying assumption that all the pairwise correlations are the same, then this formula simplifies to this. You don't need to know the derivation or the logic, but can you remember this? The variance of a portfolio is equal to, what do you think this represents? Sigma square. Variance. Variance of what? Yeah, now we are assuming that all the variances are the same, right? So we don't need to explicitly say average now, because we are making an assumption that every stock has the same variance. Okay, so the question is, if all the correlations are the same and all the variances are the same, does making a portfolio benefit you over having a single stock? Okay, so that is actually that question is a great question for a finance teacher, because it illustrates a very core point. So I will actually take a couple of minutes to answer that. Let's say you have three stocks A, B and C. Okay, stock A is let's say a stock such as Microsoft. Stock B is General Electric, and stock C is Caterpillar. Okay, three large American stocks in different industries. For the sake, while this is not absolutely true, but for the sake of this discussion, let's say that they all have the same standard deviation. Let's say that they have we are not talking about expected return, they have different expected returns, just for simplicity. Or actually for simplicity, let's say they have the same expected returns. And the correlations, A, B, C, the correlation between A and B, B and C, and A and C is the same. Let's say that the correlation is 0.3. So all these are 0.3. Now just think about it. If you just put all your $1 million in Microsoft, would that be safer? Or if you take your $1 million, put a third in Microsoft, a third in GE, and a third in Caterpillar, what would be a better portfolio? A third. The fact is, even though the standard deviations are all the same and the correlations are the same, but still there will be there will be a diversification benefit, because if you put all your money in Microsoft, there is systematic risk plus there is idiosyncratic Microsoft specific risk. Okay, but when you create a portfolio, you are getting some diversification benefit. You are coming from this point down to maybe this point. Okay, but at this stage, from an exam perspective, this is the formula you need to memorize. Is it memorized? Just looking at this formula, as n becomes large, what do you think will happen to this formula? If n becomes large, what happens to this part of the expression? This becomes what? 1. This becomes 1. If the denominator becomes very large, what will happen? If n becomes very large, this becomes, there's a reason I put it this way. This becomes close to 0. So then what does your variance become? The variance is then what? Sigma squared into the correlation. So if you are given that your portfolio is becoming large, then the variance of the portfolio simplifies to this. Okay. Portfolio choice with a risk-free asset and the derivation of the capital allocation line. Again, we are back to a recap of level 1 material. So the way this goes is as follows. If you remember from level 1, again, let's say that you, on the x-axis you have risk, on the y-axis you have expected return, and let's say that we create, so you are a portfolio manager and you've identified a whole bunch of different portfolios that you can create. Okay, then you essentially create this, what's this line called? No, this is not, this is your minimum variance frontier, so that for every level of return you are looking at your minimum, for every level of risk, what is the minimum risk. Okay, now as we've discussed earlier, the upper part of this is the efficient frontier. What is a limitation in creating this? The limitation is that we only consider risky assets. Remember, so this is all these dots represent portfolios made up of risky assets. And the other point, when we are talking about capital allocation line, the way you can think of this is, at this stage you are the portfolio manager and you are creating these different portfolios based on your expectations of the market. Somebody else, if they are creating the efficient frontier, they would create something different. Why? Because the other portfolio manager might have a different assumption about expected returns, variances, correlations, and so on. So is it easy to sort of relate to the fact that different managers will have different expectations about risk, correlation, etc.? If so, then is it easy to relate to the fact that different managers will create a different efficient frontier? Yeah, so this is the efficient frontier for a given portfolio manager based on his assumptions. Next, let's say that you relax the assumption about not having a risk-free asset. So if you have a risk-free asset, let's say it's a government T-bill. So where will that plot? It will plot right here. So what's this rate? It's the risk-free rate. And what does this point represent? Zero risk. So let's say this is your T-bill. Okay, then going back to level 1, your capital allocation line is the straight line that starts from here and it goes, it tangentially touches the efficient frontier. So this is going to test my drawing skills, but you start from here and so that's called the, at least in the curriculum the way they refer to it over here, that's called the tangency portfolio. What do you think that means? It's the portfolio, that portfolio such that a line that starts from here is tangential with the efficient frontier. Okay, and this particular line is called the capital allocation line. Okay, so what is the return at this point? That return is depicted by that expected return is the expected return, and then you have the subscript T. What do you think the T stands for? The point of, you know, that's the point of tangency. And then what do you think this thing is called? Yeah, that's called, they are calling it standard deviation of RT. Okay, so the standard deviation of that portfolio. So RT is that portfolio at tangency. That's the expected return of RT, and that's the standard deviation. So what is the formula? Actually, what does this line mean? This line means that if you have this, so now you think of two assets. One asset is the risk-free asset, and then you have this RT asset. This tangency asset, its expected return is given by this, its risk is given by this. Now you can combine the risk-free asset with this asset T in different weightages. What does this point A represent? 100% risk-free asset. What does this point represent? No, this T represents 100% in portfolio T. And then what about points between A and T? So this is different weightages. Halfway in between, what will we have? We'll have 50% of our money in the risk-free asset and 50% in T. Okay, now how can we derive the equation for Cal? The simple thing to do is, do you recall from class 9 this form y is equal to mx plus c? What is the y? It's the expected return of a portfolio. What is the c? It's the risk-free rate. Let's just put the c first to put it in this form. So the c is coming first. That's the intercept or the y-axis, which is rf, plus what is the slope? The slope is the change in y over change in x. What's this distance? It is the expected return on t minus rf divided by what's the change in x? It's the standard deviation. So it's the standard deviation of the not the risk-free rate. What's the standard deviation of the risk-free asset? That's 0. So this is this distance. That's the standard deviation of portfolio T. And then all this multiplied by what is x? The x is the standard deviation of the portfolio. So effectively what we have done is derived this formula. Now, what is the standard deviation of the portfolio as you change the weightage? Is this easy to derive? This is fairly easy to derive. I'll just do it for you very quickly. Do you remember the formula? So I'm just going to do this right up here. Do you remember the formula for standard deviation of a portfolio? So standard deviation of a portfolio, or this, let's just work in squared, is equal to what? W1 squared sigma 1 squared plus W2 squared sigma 2 squared plus what? 2 W1 W2 correlation and sigma 1 sigma 2. What's the correlation between your portfolio T and the risk-free asset? It's 0. So that's 0. Then what are you left with? So that means what's W2? The correlation, let's say 2 is your risk-free asset. So that's also 0. So that means your standard deviation is W1 squared, where W1 is what? The weightage of T. Okay, so you are left with this. So your portfolio standard deviation is the weight of T, which is this guy, times the standard deviation of portfolio T. What have we done? And what do you need to memorize? You need to memorize what is the Cal and what are the formulas for the Cal. Okay, now some of you who took level 1 more than a year ago, okay, at that time in the level 1 course, they just talked about CML, they didn't talk about the CAL. So if you did this a while back, the CAL will be somewhat new to you. Just take this statement and it will help you understand the difference. What did I say on the previous slide with regards to expectations that different portfolio managers have? The CAL or the capital allocation line does not assume, actually the CAL assumes that different people have different assumptions. Okay, so that is a practical scenario. Now if you move into a more theoretical world where we make an assumption that, let's say, everybody has homogeneous expectations, i.e. everybody has the same expectation about expected return, about variances, covariances, etc., then the CAL becomes the CML. Okay, when investors share identical expectations about the mean returns, variances of returns, and correlations of risky assets, the CAL for all investors is the same and is known as the capital market line or CML. Sounds familiar? Does this equation look familiar? It's the same equation. The only subtle difference is that rather than, so I'll just do this very quickly, The subtle difference is that now that you have this, it's all the XY axis is the same. This tangency portfolio is called the market portfolio. And I won't go into details because you don't need to know those details. This is your combination of all risky assets, and the proxy for this typically is some index such as the S&P 500 and so on. Okay, so in the CML, I'll just put this graph as in just to help you remember. In the CAL, you call this portfolio the tangency point. In capital market line, you call that the market portfolio. Okay. Now, this is still part of your course because it is so important. But if you don't know this, then there are huge issues. Okay, the CAPM. Okay, do these assumptions look familiar? I will not read these. If you want, you can pause the video and just read them a couple of times, because don't ignore the simple stuff. You need to know it. And this is your CAPM. What's the relationship between CAPM and SML? Sometimes you hear CAPM, sometimes you hear SML. What can you say something that links CAPM with SML? Okay, so here is a really basic. Exactly, SML is a graphical depiction of CAPM. They are the same thing. The security market line is simply a graphical depiction of the capital asset pricing model. Okay, so I'm glad I didn't just brush past that. Okay, so obviously you have a lot of brushing up to do.